Welcome to the Absence and Assumed Pensionable Pay Employers Training presentation. My name is Richard Quinn and I'm part of the engagement team at Local Pensions Partnership Administration, and I will be guiding you through today's session. The purpose of this presentation is to provide you with an understanding of how absences are dealt with in the LGPS and dealing with assumed pensionable pay. First, let's look at the key points that will be covered in today's session. The session is broken down into two parts. In part one, I will provide you with a quick recap of the care scheme to set the scene to really outline the implication of absence and, if not dealt with properly, the implications this can have. I will talk you through assumed pensionable pay, covering the theory, how to calculate assumed pensionable pay, how to apply assumed pensionable pay, and I will also talk about increasing assumed pensionable pay. But this is quite a rare scenario, so it's just more to make you aware of it. I will then provide you with a demonstration of the assumed pensionable pay calculator tool. Calculating assumed pensionable pay has now been made easier with our APP calculator, which has been designed to assist you in the process of calculating the assumed pensionable pay and may be useful to anyone whose payroll system doesn't have provision for calculating assumed pensionable pay. There are other scenarios where APP is applicable other than absences, so I will talk you through the additional scenarios that would require you to submit assumed pensionable pay. In part two, I will cover absences that are not protected by assumed pensionable pay and also touch on buying back lost pension and how it affects pensions being built up and what your responsibilities are as an employer. From the 1st of April 2014, the LGPS changed to a career average revalued earning scheme known as a care scheme. This means that the pension builds up as an average of the pay that members receive throughout their career. For each year they work, we look at how much pensionable earnings they have received and take that figure and divide that by 49, which is the accrual rate of the scheme. The accrual rate is simply the rate at which the pension builds up. If the member was in the 50-50 section of the care scheme, the accrual rate would be a 98th and would mean they build up half of the pension they would build up if they had been in the main scheme. Each year, the annual pension scheme members' purchase is revalued in line with inflation based on the Consumer Price Index, known as CPI. This allows the pension to retain its value through to retirement and in line with the cost of living. If we look at the example on the slide, the pensionable pay the member received is £25,000 per annum. The accrual rate if they're in the main care scheme is a 49th. A 49th of 25,000 would purchase an annual pension of £510.20. If the member was in the 50-50 scheme, the accrual rate would be a 98th and would mean they build up half the pension had they been in the main care scheme. The scheme aims to protect the pension members build up for certain types of absence, and APP should be used in replacement of pensionable pay received when the member is absent for any reasons that are considered protected leave. For example, should the member have suffered a reduction in the pensionable pay they receive as a result of sickness, and their pensionable pay reduces to £12,500 per annum, based on a 49th, the annual pension this would purchase would be £255.10. This would mean that the annual pension pot they build up is less than what they would normally have built up had they not had any reductions in their pay. In these instances, we would expect you to calculate and report the APP figure, effectively ignoring the reductions in pay. APP is designed to protect members' pension pots where they have had a period of protected absence. During any protected periods of absence, the employer must report APP to LPPA so that we can calculate the member's pension pot based on the APP and not the actual pensionable pay received by the member. APP would apply in the following protected types of leave: ordinary maternity, paternity or adoption leave, sickness or injury leave, and reserve forces leave. You should report APP to LPPA either on the monthly data file or the year-end monthly files that you submit in replacement of the actual, if any, pensionable pay received. Payment of employer contribution should be based on the value of APP, and you should include APP on any leaver forms where applicable. I will cover more on this in the later presentation. Now I would like to touch on how APP is calculated. To calculate assumed pensionable pay for any employees who are paid monthly, there are 4 easy steps to follow. Step 1. What we would do is look at the pensionable pay received in the 3 months preceding the pay period in which APP becomes effective. So effectively the pay period where the pay has been reduced or nil pay. For example, if someone has a reduction in pay in September 2021, we would look at the 3 previous months. In this instance would be June, July and August. We would need to take the average pensionable pay of those 3 months. So we do this by adding the 3 months together and dividing by 3. We would only need to do this if there is a difference in the monthly amount from one month to next. Step 2. We would take off any lump sums received during that period, regular and irregular lump sums, essentially determining the basic pay and deducting any additional payments such as overtime and weekends, for example. Step 3. We would gross up to an annual amount, so this is multiplying the average of the 3 months by 12. Step 4. We would then add back any regular lump sums during the 12-month preceding the effective date. A regular lump sum is a lump sum you deem to be regular and would have been paid regularly throughout the 12-month period. If a member has only worked overtime twice out of the 12 months, you may deem this as not regular and therefore not add this back in. It is all about reaching a reasonable representation what the individual would receive had they been in work and not on absence. Once you have calculated your APP, you then need to apply this to the period the pay has been affected. For employees with multiple posts, you should carry out separate calculations for APP on each post. For employees paid on different frequencies, please see the full guide for further instructions available on the Absence and Pay website. Additionally, where the pensionable pay received was, in the opinion of the employer, materially lower than the level of pensionable pay that the member normally receives, the employer has discretion to replace the actual pensionable pay received with a higher level of pensionable pay to reflect the level of pensionable pay that the member would normally have received. An employer must have regard to the level of pensionable pay received in the previous 12 months when working out what level of pensionable pay the member normally receives. So now we're going to look at an APP example. So if a member went on to half pay due to sickness on the 17th of June 2020 and left on the 31st of July 2020, Step 1, we would look at the 3 full months prior to the reduction. So as this person went on half pay on the 17th of June, so we are looking at March, April and May. Step 2 would be to deduct any regular or irregular lump sums. In this particular scenario, this member doesn't have any lump sums, so there's no action to take for step 2. We would annualize the amount, so that's adding the 3 figures together from March, April and May, and then times that by 4 to give us the annual amount of £13,600. Or we would add back any lump sums from the previous 12 months, but as I've said in this particular example, there isn't any lump sums to add in. This would then give us an annual assumed pensionable pay amount of £13,600 and a monthly APP value of £1,133.33. I'm now going to give you an overview of the scenario to apply APP for a member who has gone on reduced pay mid-month. This is going to be the most common type of scenario and also enables us to put the theory into practice. As we looked on the previous slide when calculating APP, this person went on to half pay from the 17th of June. This means for the first 16 days, so from the 1st to the 16th, the member would be entitled to their full rate of pay. So this means the normal wage of £1,200 a month is prorated for the 16 days, which would give us £640. From the 17th of June to the 30th of June, they were on half pay of £600, and if we prorate this down for the 14 days, the member would have received £280. However, this value needs to be replaced with APP. Applying APP, we would simply take the £1,133.33 and prorata this for the 14 days to give us a new figure of £528.89. The pay which then should be reported for June should be the cumulative of the £640 plus the £528.89, which would give us a cumulative total of £1,168.89 in the first month of APP being applied. This may produce a higher figure than the monthly APP calculated figure due to them being entitled to two rates and the reduction taking effect mid-month. For July, they would receive £600, which represented the full month of half pay. However, the July pay to be reported would be replaced with the APP figure of £1,133.33. The important thing to note here is that the employer would pay contributions based on APP, whereas the member should pay contributions on the pay they actually receive. Increasing assumed pensionable pay. This is something I mentioned at the start, and as I've said, these are generally very rare. APP must be increased on the 1st April following the date from which it was effective. The increase is determined by the revaluation adjustment determined by the Secretary of State, which will be published in the Employer Bulletin each year end. So, for example, if the member goes on APP on June 2020, if the member was still in receipt of APP after the 1st of April 2022, then the value of APP should be increased by pensions increase. This is generally more if people are on sickness and tend to be on long-term sick, whereas other scenarios it will probably be very rare that you'll come across that if it was said maternity or paternity. What I would like to do now is just make you aware of some of the resources you've got access to in order to assist you with absence and pay. The first resource you have access to is the APP calculator tool, which is available on the LPPA Pensions website. If you select the Employers drop-down box on the home page and then select Absence and Pay, you can access the APP calculator tool spreadsheet here. There's also the APP calculator user guide on how to complete the APP calculator tool. I will be providing a demonstration of the APP calculator tool shortly. The final resource I would like to make you aware of is the LGA bite-sized training available through the lgpsregs.org website. This can be accessed via the link on the screen or via the training page on the LPPA website. If you select the Employers drop-down on the home page, click Training, and then scroll down to the Training Programs tile, click this tile, and then from this page, if you click on the link for LGA online resources, and then click Employer Bite-Sized Training, this will take you to a suite of short interactive courses that you can work through covering topics such as what is APP, calculating APP, APP and pension contributions, APP and the 50/50 section, APP and kit, split and stringer days, and finally APP for ill health and death benefits. These are very useful as they are fun and interactive way to improve your understanding, and they have tasks to test and reaffirm the learning. To access the APP calculator tool, if you access www.lppapensions.co.uk, you can then click on the Employers drop-down menu and select Absence and Pay, and this will take you to the designated Absence and Pay page. If you scroll down to Local Government Pension Scheme Guides, you will see the Assumed Pensionable Pay Calculator and also the Assumed Pensionable Pay Calculator User Guide. If you then click on download at the end of the bar of Assumed Pensionable Pay Calculator, and then click open when prompted, and the spreadsheet will open for you. You may be required to click enable editing. And if you just click open as read only, you'll then be able to access the spreadsheet. Then what you need to do is just fill in all the details of the green boxes. So if you're using this to calculate APP and report it to us, you would need to complete the member name, the national insurance number, and the pay reference number. Then in month 1, month 2, and month 3, these are the 3 months prior to the reductions. So if month 1 you entered £2,000, and month 2 and month 3 £2,100. You will then see that the annual APP figure and the monthly APP figure have been automatically calculated for you. Then in the bottom left-hand corner of the screen, you'll see a section to input the regular lump sums in the previous 12 months. If any figure is the same amount each month, you can just enter this figure into month 1 and then click on the small square at the bottom of the cell and drag this down to the rest of the months. Then if there's any months that have received additional payments, you can then just manually input these. So for example, month 4, if we change that to £100, month 8 to £75, and month 10 again to £100, you'll see that the annual APP figure and monthly APP figure have automatically been updated. You can then forward this to us via the employer contact us form, or just use the spreadsheet purely to assist you in calculating assumed pensionable pay. What happens if for any reason you have forgotten to report APP to us? This will mean that the member's pension will have been based on the reduced pay on the monthly data file or the year-end file. We would therefore have based the member's pension on the reduced pay, which is incorrect. So what we would need you to do in this scenario is complete a pension pot adjustment form. It is an online form which is quick and easy to complete. It's just a case of inputting the employee's details, and you either correct the value of pay or the scheme section. In this scenario, we would expect details in the pensionable pay changes field and input the relevant date. There are a number of reasons to select why for a pension pot adjustment form. For purposes of APP, you would select the other scenario option by clicking the radial button and then enter the pensionable pay changes fields. It's really important, should you forget to report APP on the submission file, we can go back and recalculate the member's pension based on the correct value of pay. If we get to year end and that we can see that the member's pay is reduced throughout the year and we can't see if there's been an hour's change or a change of contract, we would come back to you and query that information. The less queries you have at the year end, the better. And it's really good practice to pick these up potential mistakes and errors throughout the year so it makes your year end process as quick and painless as possible. As mentioned at the start, there are a couple of other scenarios where APP is required. This is something that can be quite misunderstood across the board and can cause a bit of confusion, especially due to members not having any reductions in pay as a result of absence. So logically, you would assume that APP doesn't apply. However, for the purposes of ill health retirement, when we're calculating enhancements for Tier 1 and Tier 2, we will be asking for the APP. We do also ask for the APP for a Tier 3, as this could be uplifted as part of the review later down the line. We do find we have to go back and ask for that information when they haven't been on sick. This can cause a delay in the process to the ill health retirements. So please be mindful, you do need to calculate APP for ill health retirements, even if there haven't been any periods or reduced pay or nil pay as a result of protected absence. In addition, death in service, the regulations outline that we should base the calculation of the lump sum death grant and any survivor's benefits based on the assumed pensionable pay. Where a member has reduced their contractual hours because of ill health and had reduced pay as a result, the reduction in pay is ignored when calculating the APP, which is used to determine the ill health enhancement. This is as long as the reduction in hours was connected with the condition that caused or contributed to the ill health retirement, and an independent registered medical practitioner has certified to that effect. Again, with a death in service case, if a member dies in service, APP is used to calculate the death grant and survivor benefits. If the member had previously reduced their hours because of the condition that later caused or contributed to their death, the reduction in pay is ignored when calculating the APP, again provided an independent registered medical practitioner has certified to that effect. What we have predominantly talked about is when someone is on leave that is protected and how you should calculate APP and provide this information. However, if someone has left employment without returning to work, when someone has left and they're on protected leave, what we're looking for on the member's leave form is the APP and to be included on the monthly data file or year-end submission. If the member holds final salary benefits, this means that they joined the scheme prior to the 1st of April 2014, then they will have final salary benefits. If they do and had a period of protected leave, when you're reporting to us the final pay, you will need to report to us the notional pay, which is simply the pay they would have received had they been in work. If a member has had any period of absence where they are not protected by APP, for example, if someone has been on a career break and authorised unpaid leave and they do not return to work, in this scenario, the member has lost the pension for that period. If someone is leaving in that scenario, you would report no pensionable pay on the leaver form as they have not received any pensionable pay or paid any contributions. The same logic would apply to their final salary benefits. You would report no pay for that period. So effectively, there's no extra steps to take on the leaver form for final salary benefits if the leaver has occurred during the final pay period. You should show this in the final salary calculation. So it's just making us aware that they've had periods of unauthorised absences where they have not paid any contributions. It's just so we can make you aware of it and update our records accordingly. There are a number of types of absences where the protection covered by APP does not apply, and therefore the member will lose pension when as a result of the absence. This will include additional maternity, paternity and adoption leave, which is usually unpaid, authorised unpaid leave, for example, if they've had additional annual leave or career breaks, parental bereavement leave, and strike leave, which is classed as unauthorised leave. The member will lose pension if they have a period of strike leave. So what you need to do in these situations is when a scheme member has a period of absence that is not protected by APP, they will not accrue pension for this period. If the leave is classed as authorised, then you have a responsibility to contact the scheme member to notify them of lost pension and responsibility to have the opportunity to buy back the lost pension at a shared cost. Members can buy back pension by setting up an additional pension contributions contract, otherwise known as an APC. And if the member elects to buy back the lost pension within 30 days of returning to work, then you as an employer must share the cost of buying back their lost pension. As an employer, you can extend the 30-day deadline at your discretion. So if there's any unforeseen circumstances which has not enabled them to do that, then obviously you do have that discretion to extend that 30 days. Here we have the steps that you would need to take for a shared cost APC. In this scenario, the member returns to work following a 12-month career break, authorised period of leave that is not protected by APP. Step 1, you would need to calculate the lost pension. You would work this out by considering the member's lost pay, the pay they would have received had they been in work. So it's effectively the lost pay divided by a 49th. So 25,000 divided by 49 would mean that the lost pension is £510.20. Then step 2, you would complete section A of the APC buying back lost pension form and send it to the member. There is the employer guide for the template covering letter on the website, so you can access that for further guidance, or you can send your own letter if you wish to. Step 3, the member should visit the LGPS website to determine the cost and decide if they want to buy back the lost pension. They should then complete section B of the form accordingly, indicating if they elect to buy back or not buy back the lost pension and send back to you as the employer. Because it's authorised unpaid leave, you as the employer are responsible for covering 2/3 of the cost should the employee decide to purchase the lost pension. You do have the discretion to extend the 30-day period should you wish. An example of extending the deadline is if you have not gotten around to contacting the member within their first 30 days of returning to work, then it would be reasonable to extend this deadline. Then step 4, as the employer, you would set up the deductions through the payroll if applicable, complete section C accordingly and forward a copy to LPPA. If they decide not to buy back lost pension, we do ask you to forward the form on to us to notify us so that we can update our records accordingly. I just want to go through a couple of points on furlough leave. If you have dealt with any members who you've placed on the furlough scheme, and I just wanted to touch on a couple of points that may impact their pension. The employer is unable to reclaim any employer contributions for the period from the 1st of August 2020. And members will continue to build up care pension based on the actual pay they receive, including the part funded by the government. If the pay they received is less than normal because the employer chooses not to top up to the 100%, then the pension they build up will also be less. The member may be eligible to buy additional extra pension to make up the pension lost during this period. Final salary benefits are usually calculated using the pensionable pay earned in the year before leaving the scheme. However, one of the 2 previous years' pay is used if higher. This should prevent final salary benefits from being detrimentally affected if the member's pay is reduced while in a support scheme. As a local government pension scheme employer, this shouldn't come up too often, but I just wanted to touch on the points just to make you aware. What I would like to do now is just go over the absence summary as a point of reference, covering the common types of absence, whether or not APP applies, whether the pension's protected, and then outline the implication of the employer contributions that are payable. If we look at the various reasons for absence, we have ordinary maternity, paternity, and adoption leave. APP applies, the pension is protected, and employer contributions are payable on APP unless the actual pay is higher. We have sickness and injury leave. Again, APP applies, the pension is protected, and the employer contributions are payable on the APP. You've got reserved forces leave. Again, APP applies and the pension is protected. The employer contributions are payable on the APP figure, but these will be paid by the Ministry of Defence. You can then have a career break, strike leave, additional annual leave reducing members' gross pay, and additional annual leave reducing members' net pay, which is where APP doesn't apply. There's only the additional annual leave reducing members' net pay that the pension is protected, and it would normally be based on the normal pay that they would have received. Any absences that are classed as authorised leave, the member can buy back that leave within the first 30 days of leave, and you, as the employer, would have the responsibility to cover 2/3 of the cost. Unauthorised leave, you wouldn't be obliged to contribute to the cost of buying back that lost pension. There is also a consideration for additional annual leave. This is all dependent on how that's been accounted for in the member's pay. If the pensionable pay is being reduced, their pension is going to be affected. If it is authorised additional leave, then the member is entitled to buy back at a shared cost. If the pensionable pay is being accounted for in their net pay, then this is unaffected. Here we just have a disclaimer which obviously just outlines that I have talked you through today is based on our understanding of the LGPS regulations, and so that is just there for your reference. And that brings us to the end of the presentation. Further information is available on the lppapensions.co.uk website. And if you do have any further questions regarding this session, then we do ask you to contact us via the Employer Contact Us form, which can be accessed at lppapensions.co.uk/contact-LPPA. Thank you very much.